but we are doing a financial literacy series, and I'll talk about who we are in just one moment. And the purpose of this is really just to share some insightful tips, tricks, advice, things you may know, things you may not, just to bring your money management skills to the next level. So again, thank you so much for sharing your Sunday with us. As some quick introductions, my name is Leora Rayflat, so I'm a senior strategic change consultant at Deloitte. I really love financial literacy. I'm really passionate about it, talking money, all those things. I'm all about that. So really excited to share some insights, tips, tricks, as we mentioned with you. I'm a global shaper, and we'll talk about what that means in just a moment. And I've been with the team for a few years now. Typically, we do these financial literacy sessions for a bit of a younger audience, and obviously, pre-COVID, we would do this in person. Given how things are, we decided to take things a little bit more virtual and really expand the types of knowledge that we share. So instead of doing a one-day thing, we're actually doing a weekly session, well, almost weekly in the month of November. So really excited to be here, and I'll pass it over to Haruka. And the key thing is to always bet every dollar.
There you go. Hi, everyone. My name is Haruka Kumaratne. So I'm a chartered accountant or CPA by trade, and I'm currently a director of finance at a tech company here in Ottawa called Kivuto Solutions. So I've been part of the Global Shaper community since 2016 and have been involved in our financial literacy projects for the past couple of years. And as Leora mentioned, naturally, given everything that's going on related to COVID, we've decided to take our Finlit projects virtual. So to help us bring some of these financial literacy concepts to life, we're very, very excited to introduce our money expert, Ben Felix. So Ben is a portfolio manager here in Ottawa at PWL Capital. He has an MBA from the Sprott School of Business here in Ottawa and is a certified financial planner and a chartered financial analyst. So he's truly an expert on the topic. Ben, if I've covered your background, if you want to add a couple notes there, feel free.
No, I think you did a great job. I've got nothing to add, but I'm happy to be here.
Perfect. And I do want to note, beyond Ben's impressive set of credentials and experience, he also has been educating thousands of people about financial literacy and investing through his very successful YouTube channel with over 167,000 subscribers, I might add, called Common Sense Investing. And I personally watched tons of his videos, and I just grabbed a couple of the excerpts in terms of YouTube comments and Reddit comments and feedback on what Ben does. And one of them I really resonated with. I swear I wasn't the one who wrote the comment, but Ben is an investing master. I feel smarter every time I watch his videos. So that is very true. So we're very lucky to have Ben with us. And with that, keep in mind, any questions you have, keep them in mind, and we have a Q&A session as well. So please take the opportunity to get your questions answered. Over to you, Leora.
Awesome. Thank you so much. And Ben, so excited to have you here. So we mentioned we're part of a Global Shaper community. So for those of you who aren't familiar with what we're all about, so the Global Shaper community is actually a worldwide community born out of the World Economic Forum. So it's a number of folks who are typically under the age of 33 or so, all over the world in all sorts of different chapters and cities, essentially working together to address local, regional, and global challenges. So us, based in Ottawa, one of our initiatives is on financial literacy. So that's why we're doing these initiatives here today. And we're also here with partnered with ZalaSmart. And ZalaSmart is actually one of the companies founded by one of our very own shapers, Tekla. And ZalaSmart is all about teaching kids and teens the essential life skills of financial literacy via storytelling, experiential learning, and games. So we're really excited to bring in the shapers and ZalaSmart together for not only this session, but all the sessions in November. So hopefully we can stay tuned to those. Now, before we really dive in and get started about what financial literacy is all about, we're going to do one activity. And in this activity, I'm asking you to either pull out your phones or type in menti.com in your browser, and you can check out the code on the screen here. So for those of you who have put in menti.com, MENTI.com, the code is 7839703, and hopefully we can paste it in the chat there. And so as you're kind of getting your phones out or your computers or whatever you have in front of you, take a moment to put in a word that comes to mind when you think of financial literacy. And we really just want to get a sense of what some folks are thinking about when we say financial literacy. It can mean so many different things to different people. So I just want to get a sense, and Haruka and Ben want to get a sense of where we're at in terms of what comes to mind when we think of financial literacy. So make sure you pop open the Menti, pop open the chat there if it isn't, and I'll start looking over into the Mentimeter. And this is pretty exciting. We can actually see the words come in. So I'll give it a minute here. And this is awesome. Look at all these words coming in. I'm loving it. So money is a big one, of course, absolutely. Investments, saving, I love it. Lots of saving and savings. Budgeting, absolutely. Strategic investing, long-term planning, money management, banking, freedom, I love that. Financial freedom, absolutely. Tax, for sure. Can't think of financial literacy without thinking about tax.
Those good old taxes.
Perfect. Getting out of debt. I love it. Stocks for sure. Awesome. Awesome. Thanks so much for participating, folks. This is fantastic. I love to see all the words that come to mind. And it's fantastic because it really gives us a sense of, where we're at in terms of what we think about with financial literacy. And all the words you just mentioned, and thanks very much for, engaging with that, is all the types of things that we'll cover in this session. This session in particular, in the next little hour or so, we're going to really focus on really high level, really key fundamentals, touching on budgeting, touching on investing. But as we mentioned, we're actually going to do full 1 hour deep dives in the following sessions this month with budgeting, investing, and even some money diaries. But we'll touch on that later. So why are we doing this right now? Well, for those of you who don't know, November is actually Financial Literacy Month. Given the state of the world, I don't need to jump into it. I don't have to say the new normal. We're so tired of hearing that, but it is the reality. November is Financial Literacy Month, and so we thought this would be a good time to really have a bit of a reflection, a bit of a step back and think about what is our money doing for us? How is our money working for us? And what are we doing with our money? And so the question that could come to mind is, okay, so what does financial literacy really mean? At its core, financial literacy is the ability to understand and effectively use various financial skills. So you don't have to be a money expert like Ben or a CPA like Haruka. It's really understanding how are the tools you have available and how your money is working for you. And what we're trying to get through with this session is how accessible financial literacy can be and how important it is to understand how financial literacy can really help you understand how you can set yourself up for success. In this session, in this series, really, we'll talk about two key things. The two key things you really brought up with the word map. And the two big words I saw, which you guys got, was around budgeting and around investing. And it's so important to understand what this actually means for you. Oftentimes we hear budgeting and we're like, yeah, I need a budget. Or investing, like, yeah, I should start investing soon. But what does that actually mean? And why does that actually help you? That's what we're here today to touch on. Now, this is kind of my favorite part because I mentioned I love talking about money. I love talking about financial literacy, been doing it for years. And so has Haruka, but that's not to say that, we ourselves haven't done some hiccups before. And I think it's important to understand that our own financial literacy journeys and our own understanding of what's right and, what could we have done better. Well, it really evolves the more you kind of understand yourself and the more you understand what's available for you. So at this point, maybe I'll turn to Haruka. And Haruka, I know you're a money expert too, but was there a time when you felt that you probably could have managed your money a little bit better?
Oh, absolutely. So I've definitely had hiccups along the way, and I blame it on being very caught up at work and being busy. But I'll give you one story. So that may seem like a good financial decision, but certainly could have been a better one. So right out of university, I saved a whole bunch of money through my co-op program, and I chose to buy a car starting my new job because we had to travel quite a bit to client sites. I made a good decision in buying a used car, which has been significantly depreciated versus a new car. However, at the time, I did have access to low interest line of credit that I could have used to finance my car purchase. However, I decided to pay for it in cash, which at the time was a substantial amount of my savings, a big percentage. So you may be thinking, wait, taking a line of credit isn't good, paying for it in cash is the right decision. But it's a misconception based, it really depends on what you want to do with your money, right? So for me, I felt in hindsight, I could have invested a portion of my money that I had saved in my savings account versus put it all towards a car. But I hope by the end of this session, we'll have a better idea of why I think I could have made a better decision related to my car purchase. But Leora, what about yourself?
Well, Haruka, I'm a money expert. No, I'm kidding. Of course, I absolutely. One of my biggest mistakes, and I know that Ben will be cringing quite hard as he hears this, is when I was 18, I was really excited because I was always passionate about making sure I'm doing the right thing with my money, and I wanted to budget and invest and all those things. So when I turned 18, I opened my TFSA account and I opened it up with my bank and put some money in there. And then I forgot about it for, I'm not going to say how long. And the worst part about this is, even though I understood the concept of saving and investing, it clearly wasn't, good enough to really take the time and reflect and say, I should probably be investing the money in my tax-free savings account, which in hindsight should probably be called a tax-free investing account. And I mean, it's embarrassing to share, of course, but this is actually something that tons of Canadians do. Open up their tax-free savings account, put a chunk of money in, set it and forget it without investing. And so hopefully throughout this session, the next few sessions, we'll understand what we can actually do instead to avoid some of the money mistakes or areas of opportunity for growth with our money, like Haruka and I shared. And so why are we talking about this? Well, it's common for people to shy away from money talk. In fact, even as Haruka and I were putting together this presentation, these two anecdotes came out. And even in just sharing and laughing about it and understanding, we were actually able to learn a little bit of something and grow it in our own way. So it's important to, yes, talk about money, share what you can be doing, but it's also never too late to start your own journey of improving your own money adventures and where you're off to. Oftentimes, perhaps we hear family, friends, coworkers, folks say, I'll look into things when I'll make more money. Like, I'm not making enough to really invest. Or maybe you're thinking, I don't understand the stock market. No way am I risking my money on that. Or maybe, like me, you're not a numbers person. So let's just stay clear of that. These are all really valid ways to push it off and totally understandable. But at the end of the day, the right time to make a change is now. And while you'll never feel 100% ready, it is important to get started wherever you are on your financial journey. And so at this point, I'll share it over to Haruka for him to touch a little bit more about the key components of financial literacy.
Thank you, Leora. Yeah, so Leora is certainly right. There's a lot you can do regardless of what situation you're in. And in diving into financial literacy, there's several components to it. However, the two fundamental components to be aware of, as we mentioned, is budgeting and investing. And we'll dive into why they are such a critical component and how they're linked together shortly. But before we do, I do want to remind that we do have two other sessions later on this month that are focused specifically on these two topics, and we'll do a deep dive with greater detail. So when it comes to budgeting, to understand why budgeting is important, we must ensure we know what budgeting is to begin with. So to put simply, budgeting is the process of creating a plan for every dollar you earn. Making a budget is the most important thing you can do to manage your money. But many people are reluctant to take this beneficial first step for a variety of reasons, right? They may associate budgeting with restrictions, having a lot of hassle and headaches, or you may think you're not earning enough or earning too little to even worry about it at the moment. However, budgeting is essential because it can help you save money instead of overspending and enables you to make the most of every dollar regardless of your income. So it's one of the most essential financial habits that you can adopt. But if you've never lived on a budget or experienced all the benefits of budgeting and what it has to offer, it's easy to wonder why it's such a prominent aspect of personal finance. So why is budgeting important? So to put simply, living on a budget is is a fundamental component of proper financial management and will provide you with two key outcomes at the end of the day: financial freedom and reduced financial stress. So let's take a deeper dive into the importance of budgeting and why it's such a vital part of your financial well-being based on these two outcomes. So financial freedom. So what does that mean? So one definition here is having enough savings, financial investments, and cash on hand to afford the kind of life we desire for ourselves and our families. And this is very much defined by you, right? It's very different for every single person. So in order to obtain financial freedom, we need to have a defined financial goals that will ensure we are planning for the future life that we're aspiring to live. So to achieve a goal, we need to stick to a plan, stay focused on a clearly defined process, and that's where having a budget is so important. Through a budget, you can really reverse engineer your goals and develop a clearly defined process to achieve them. In essence, when you create a budget, you are setting boundaries on your financial behavior so that you could stay on track and achieve every goal you set out for yourself. So this will allow you to prepare for major life events. So think of a potential wedding coming up, a new car, saving for a vacation that you'll probably only likely take in 2022, given COVID and everything else that's going on, but you get the point, right? So on a practical level, if we were looking at, budgeting for a vacation, what that could look like in terms of setting a goal, putting aside $100 a month up until you plan on taking a vacation in July of 2022, right? So that's an example. But additionally, when you sit down and log your expenses into a budget, you're essentially recommitting yourself to your goals. And I can tell you from personal experience that the more often you commune with your goals and assess your progress, the more likely you are to achieve them. So as you can imagine, committing to a budgeting process also helps you reduce your financial stress. So financial stress, what is that? So it's the result of financial or economic events that create anxiety, worry, and a sense of scarcity. So I was looking this up, and the Financial Consumer Agency of Canada, they noted that many Canadians, money worries is the greatest source of stress. It beats out work, personal health, relationships in terms of a cause for stress. The research actually shows that 48% of Canadians say they've lost sleep because of financial worries. Another 44% say it would be difficult for them to meet their financial obligations if their pay is late. So they're essentially living paycheck to paycheck. Having a budgeting process can assist in alleviating this financial stress. The very nature of a budgeting process puts you in control, right? And that's the major key here. So let me put a thought out there. Have you ever been or are you disorganized when it comes to your finances? There's been a point in my past where I certainly was. But disorganization is one of the words that does not mix well with personal finance. The longer you live without a budget, the easier it becomes for your financial life to get messy. Between all of your monthly payments, your debt payments, any other expenditure that can come through, things start to slip through the cracks, payments can be missed, and it's easy to swirl into debt. Now, to add to this, all kinds of unexpected things happen in life, which require emergency expenditures, right? From hospital bills to unexpected home and car repairs, to even things much larger like COVID that were not anticipated, right? And from a personal experience, I had an unexpected car repair that cost roughly $2,000-3,000, which was very material for me. And if I had not planned for it, I would have had to dip into debt in terms of a credit card or a line of credit to pay for it, or worse, I'd have to pull from my savings, which is something I certainly don't want to do, and both options aren't great. So planning ahead can really help you plan for these unexpected emergencies that can take place. So at the end of the day, budgeting really helps to build that organization in your personal finances, and it gives you that feeling of control over your money. It allows you to focus on those debt payments and build your emergency funds while helping you prioritize your spending, track how you're doing it, and realize when you need to stop. It essentially puts a sound plan in place that should be easy to follow and gives you the chance to plan and prepare for the future. And I want to reiterate this again, it is truly the biggest tool you have to change your financial future. And it gives you the power to make those changes, starting today, if you set one up right at the end of this session. But in a nutshell, budgeting is not about limiting the fun in your life. It's about opening up opportunities to have more fun and help you worry less about your future. So at this point, I hope everyone's pumped up about budgeting. They just want to get off the session and open an Excel and fire away. But what does that look like? How should you budget? So on a very high level, there's 4 key components that you should think about. Okay, so step 1, setting a realistic goal. So goals for your money will help you make these smarter spending choices. Ask yourself, what do I want my finances to look like in 1 year? Decide what's important to you and start there, right? And then from that point on, step 2, track your income and your expenses. You probably know how much you earn each month, but do you also know where it all goes? You can find out by tracking what you're spending. Spend as you normally would for a couple of weeks, jot down every cent you spend, and it's easy, and you might be amazed by what you find. And we'll also share some tools that are useful in helping you do this. And step number 3, you want to ask yourself, you want to separate your wants and your needs, and ask yourself, do I want this or do I need this? Will spending this money get me closer to my financial goals or further away? Can I live without it? And setting clear priorities for yourself, and the decisions become easier to make once you do that. So once you've done this, you have the components to design your budget. And from this point on, there's various different ways that you can go about designing a budget that makes sense for you. But there's one golden rule here. Make sure you are not spending more than you make, right? You want to balance your budget to accommodate everything you need to pay for. And this does include your savings and debt payments. But if there's anything you take away when you're planning your budget, follow that golden rule. So to give you an example of what a budget design could look like, and like I mentioned, there's a whole bunch of approaches and methodologies you can take. But one that pops up often is the 50-30-20 rule when it comes to budgeting. And it's a very simple guideline here. You want to spend 50% of your income on your needs. So these are your essentials, things like your mortgage or your rent, your utility payments, your groceries, things of that nature. And then you would ideally have 30% of your income being spent on your wants. So these are things that are not essentials, but go towards your lifestyle. So your Netflix subscription, your video games, going out, going to sporting events or things like that. And COVID's been really helpful in helping you budget by cutting out a lot of those things for you right away. So that should help. And then 20% should be towards your savings. So this is towards your investments, your savings, as well as debt payments. So ideally, this is the breakdown of the income that you make in a month should split into this 50-30-20 bucket with this approach. And again, we'll go deeper into this in an upcoming session later in this month. And going to those tools that I mentioned that were useful. So we listed out a couple of tools, from talking to Leora and the team, tools that we've personally used. We're not saying these are the best tools, but these are tools that we've used and we've liked. So mint.com and YNAB stands for You Need a Budget, and was actually made by a CPA, so I'm biased. But they're tools that can connect to your bank account right away and can allocate all your expenses that are flowing through to the categories that you set out. So it can automate a good chunk of that process and spit out reports and graphs to show you where you are in terms of your budget and your actual spend, which is useful. But to be honest, at the end of the day, if you just have a good old Excel template, you could start there. And then the most important thing is consistency. So if you just have Excel, you have a template and you update it consistently, that's a great starting point. That's the most important thing, is that you're doing it consistently. So that's budgeting in a nutshell. We'll dig deeper into it in an upcoming session, but I really wanted to provide you more context into why budgeting is such a critical component of financial literacy and achieving your financial goals, and how it helps you get opportunities to start investing. So to speak on that, I'll pass it over to Ben, who will jump into the investing side of things.
Thanks, Haruka.
No worries.
So I wanted to touch on a couple of things that Haruka mentioned in the breakdown of the budgeting slide from Wealthsimple with the 50-30-20 rule. The 20% was for future you. Now that's really important because money is one of the most important technologies that humans have ever come up with, and it's important because it allows us to move economic value forward and backward in time, which is pretty amazing. So when we talk about future you, that's one of the biggest benefits of money. But to take advantage of that idea, of that ability to move economic value through time, we actually have to take the money that we earn today and invest it in something. So the concept of investing is allocating cash, probably income from your human capital, money that you've earned from working, taking that money and investing it in something that you expect to be worth more in the future. And when you do that, you typically expect to earn investment gains from capital gains. That's an asset appreciating in value. Interest, which is something that you get from a bond or a GIC or a bank account, except maybe not from a bank account today because interest rates are so low. And from dividends from stocks that you might own. So investing it's an activity where you take your money and expect it to increase in value through these different means. Now, the reason that this is important, there are two main reasons. One of them is inflation. So when I mentioned the ability to move economic value through time, if you do nothing with your money, literally nothing, keep it in cash, in paper, plastic bills, under your mattress, your money will actually lose purchasing power over time. We don't need to get into why inflation exists. But from an economic perspective, a little bit of inflation is actually a good thing. But one of the effects is that it decreases the purchasing power of cash over time. So at a bare minimum, just to keep the value of the money that you have to earn a little bit of an investment return. Now, to keep pace with inflation, you can probably do that with very safe investments, like a guaranteed investment certificate from the bank. If you lock it in for 5 years, you'll probably get enough to keep pace with inflation. So that's one reason. At a bare minimum, you need to be keeping pace with inflation. The second reason is probably the more important one, and it's probably what people are typically thinking about when we talk about investing. So keeping pace with inflation, great. But if you're saving to fund your future consumption, keeping pace with inflation is probably not enough. And it's probably not even an efficient use of money. And I'll try to explain why. Most people, like we talked about budgeting. Well, that's a great example, actually. We talked about budgeting and 20% is going to your future you. If we use that rule of thumb, it is a rule of thumb, like you should, a lot of people should save more than 20% of their income. That's maybe a future topic. But in that example, if you save 20% of your income, you can't expect to live, or most people can't expect to live off of that 20% of their income once they've stopped working, if it's never earned an investment return. If it's kept pace with inflation, you're living on 80% of your income until you retire. If you assume that you work for the same time period that you retire for, say it's 30 years of work and 30 years of retirement, just as easy numbers. Nobody's going to live on 80% of their income for their working years and then live on 20% when they retire, because that's how much they saved. But that's what would happen if all you earned was enough to keep pace with inflation. So this is where the idea of earning returns in excess of inflation becomes extremely important. You can actually fund future consumption at your current level of consumption by saving a relatively low portion of your income if you earn excess returns by investing. The way that you do that is by taking some risk. I mentioned that you could keep pace with inflation by investing in very safe assets. To earn higher expected returns, you have to start taking some risk. Now, risk is a complex topic, but in stocks, one of the best ways to think about risk is that the assets are they're sensitive to economic factors. Now, I'm going to try and make this tangible using Haruka's example of his car breaking down and being fortunate to have savings to cover the expense, but being fortunate because he wouldn't have had to dip into his investments. Now, sensitivity to real economic risks means that in a bad time, like that, the value of your stocks is probably going to be low. It's probably going to decrease because stock values fall based on worsening expectations. And we'll talk more about that in a second. But in Haruka's example, if he had no budget and had no savings and the only assets that he had were invested in stocks, he would have to sell those stocks at a deep discount to cover his car so he can continue working and getting groceries and stuff like that. So that's real risk. And I hope that makes it sort of tangible. Day to day, the way that materializes is that stocks tend to be volatile. So a lot of people think about volatility as risk as well. This just means the value of the assets are going to change a lot from day to day. And that's one of the reasons I think that people think about stocks as gambling or as sort of a big casino, which I don't think they are. And we'll talk more about that in a second. All right. So in general, when you're investing, when we're talking about investing, there are stocks, which I've mentioned, bonds, which I haven't really mentioned, but they were also on that chart that we were looking at a second ago. In the case of stocks, in both cases, you're funding businesses. Investors are funding businesses. I mean, it's the basis of the whole capitalist economy. When you invest in stocks, you're investing in an ownership share of a real business. You own a portion of that business's expected future profits. Now, I mentioned a second ago that stocks are sensitive to economic risks. And that's important to tie back here, where what I just said about expected future profits. So you own expected future profits when you own stocks. If expected future profits decline, like they do in bad times, like when a pandemic hits, all of a sudden expected future profits for most companies in the stock market decrease sharply. Now, those expectations in this case ended up improving fairly quickly, which is one of the reasons the market recovered. But that's the risk that you're taking as an equity owner. As much as you're taking that risk, you're also getting the potential for a lot of upside. I think that the most important way to think about stocks, it's what I just said. It's the entitlement to expected future profits. Where stock returns come from, expected stock returns, is how much of a discount you pay for those expected future profits. If we expect a company to earn $1,000 of revenue, the less you pay for that expected revenue today, the higher your return will be if you actually end up receiving that revenue. So that's stocks. And they can be volatile because expectations change frequently, but you've got high expected returns. You've also got unlimited downside in stocks. If you buy one stock and that company happens to do really poorly, you can lose all of your money. Bonds are safer. In the case of bonds, you're effectively loaning money to a company or to a government. Your principal, the amount that you effectively loan to a company, will be paid back to you, assuming that the person or the entity you've lent to remains solvent at the end of the loan term. So bonds will have a term. I don't think we need to get into too much detail about bonds here, but if it's a 10-year bond, technically after 10 years, you'll get your principal back. And over the course of that term, you'll also receive interest payments. So the interest payments are fixed, which is why bonds are known as fixed income instruments. Now, they're much safer because you get these fixed interest payments and you get your principal back, assuming that the borrower stays solvent. But you also have limited upside. If you invest in the bond of a company that ends up doing extremely well, and it's a 3% yielding bond, you're still going to get 3%. The stockholders are going to benefit tremendously if that company does well, but you as the bondholder are still going to get your 3% coupon. Now, on the flip side, if the company does poorly, the stockholders can lose everything or a lot, whereas the bondholders will be the last ones to lose, and in most cases have the first claim on the company's assets if the company goes under. So to summarize all of that, and it's actually was visible in the previous chart that we were looking at, to summarize all of that, stocks are riskier investments, but they have higher expected returns, which is important if we want to move economic value through time. Bonds are safer, and they have correspondingly lower expected returns. So all of these assets, stocks and bonds and other assets, they all exist in the market. And the market is another amazing human innovation where people can come together and take the information that they have about an asset and vote on the value of all of these stocks and bonds by buying or selling them. So if I think I have positive information about a stock and I'm willing to pay a little bit more than it's trading at right now, by doing that, by purchasing the stock and potentially moving its price a little bit, I'm taking whatever information I have and I'm injecting it into the price. And everybody else that's trading stocks, there are millions of stock trades placed every day. Everyone that's trading stocks is doing that. They're taking the information that they have and they're inputting it into the price. And if markets are liquid, which they are, and if information is available, which it is, the stock market should be pretty good at aggregating all of that information, and prices should be a pretty good reflection of what companies are actually worth. And this becomes extremely important when we're deciding how we want to be investing our money. If the prices are wrong, we're going to invest differently than if we believe that the price that the market in aggregate is setting for assets is right. So there's this concept of the wisdom of crowds, which I'm sure most people have heard about. And this is an experiment, this jelly bean experiment. It's an experiment that I've seen done live pre-COVID, obviously, many times. And it truly blows my mind every time. There's a jar of jelly beans at the front of a room, and everybody in the room has to place an independent guess. So everyone writes down on the piece of paper independently. They can't ask their neighbor, and everyone submits their guess. They're all tabulated, and without fail, and I've seen this done with jelly beans and actually with Kinder eggs too. Without fail, there's a wide range of guesses, but the average guess is always remarkably close to the actual number of whatever, jelly beans, Kinder eggs. I think this is actually the first time this was ever documented was with the weight of a bull, I believe, at a market where they did the exact same thing and got the exact same outcome. Now, this is just to illustrate the concept that together meaning all of the people participating in financial markets, we're pretty good at arriving at the actual value of a thing. Now, this works with 40 people, and with financial markets, we're talking about millions of people who are inputting their information into prices. Now, the reason that was relevant, and it is very important when we're thinking about investing, is that when we approach financial markets, we have to choose, well, how we want to approach them. And there are two main generalized categorizations for how you can invest. You can be an active investor, which is betting against the market's ability to set prices. Now, that means if we look at the market, if we look at a stock trading on the market and it's trading for $10, and if I think I have better information than the aggregation of everybody else who's trading that stock, I think it's worth $15. I should logically, in that case, take all or a bunch of my money and invest it in that stock, because the price should increase if I believe the prices are wrong. Now, that's a very distinct way of investing called active investing. On the other hand, if I believe prices are right, if I believe that $10 is the accurate value of that stock based on all available information, the only way the price is going to change is based on new information, which is like you can't predict the future. It's random by definition. So if I think that prices are right, I'm not going to try and bet on any individual stock because I'm betting on randomness. In that case, the rational approach to investing is to diversify as broadly as possible and collect the average risk premium of the market. The risk premium, I talked earlier about the concept of buying future earnings at a discount. The discount rate, so on average, the discount rate that you're purchasing future earnings of companies, that is your expected return. In a diversified portfolio, when you own all of the stocks in the market, you expect to earn that rate of return. You expect to earn that discount rate that you're paying on average for all of the profits in the market. Now, that only makes sense if we believe prices are right. So this idea of index investing and collecting a long-term risk premium makes sense if we believe that prices are right, which is why that discussion of of that was so important. And just so everyone knows, that concept can be summarized by the name that was given to it by a guy named Eugene Fama in the 1970s. It's a concept of market efficiency. So an efficient market efficiently incorporates all available information into prices. Now, for some empirical or some evidence on one of the reasons that we believe markets to be efficient. There are lots of reasons, and there's lots of different ways to approach the evidence. This one's really easy to understand. So there are funds in Canada and around the world. There are funds. So like a bunch of people pool their money together in a mutual fund, it's called, in this case. And a manager takes all of that pooled money and they do their best to outperform an index. And actually, I should mention what an index is. I haven't mentioned that yet. An index is a grouping of stocks that is designed to represent a stock market. So we talk about the market. That's kind of hard to define. What is the market? In Canada, there's an index called the S&P TSX Composite Index. So that's an index that's constructed by Standard & Poor's to be a representation of the Canadian stock market, of all of the stocks in the Canadian stock market in the weights in which they exist in the market. So a bigger company has a higher weight, a smaller company has a lower weight. So when we talk about the market, typically we're talking about the index. And an index is a grouping of stocks designed by a company like Standard & Poor's in this case to be that representation. Indexes are used as benchmarks by active managers. So people who think that they can predict when prices are wrong, if they can do that successfully, they should be able to outperform the market index. So if we look at the first bars on this chart, the Canadian equity chart, so those are the percent of active managers who underperformed the S&P TSX Composite Index, keeping in mind that their job, their proposition is that they can outperform the S&P TSX Composite Index. And you can see that over 1 year and 10 years, this is all ending June 2020, roughly 90% of the active managers fail to beat the index. And across all the different fund categories here, we can see that data are pretty similar. So what we can take away from that is that the concept of active investing, keeping in mind that these are professional active managers who are paid lots of money to attempt to beat the market on behalf of the investors in their funds, they tend to fail to do so with remarkable consistency. And this is true anywhere that we look in the world. And it's been researched academically, as well as with research like what we're looking at here. And that's some of the strongest evidence of market efficiency. Even if markets aren't perfectly efficient, as long as prices are mostly right most of the time, we would expect active managers to underperform the market. And this is like when you go into the bank and say you want to open a TFSA, in most cases, I don't want to throw all the banks under the bus because maybe there's some really good people working in bank branches out there. But in most cases, what will happen is that you will be sold an actively managed fund and told about how great the bank's active managers are and all that kind of stuff. But this is what the data say about how well they tend to do. And actually on that point, there's another major issue, and I don't have a slide on this, but I have the data in my head. There's survivorship bias in fund management. Survivorship bias means only the funds that do well survive. I guess that's what it sounds like. That's problematic though, because when a fund does well, and some do, and those are the ones that get marketed, but when a fund does well, it is exceptionally difficult to determine whether it did well because of luck or because of skill, manager skill. If a fund did well or a manager did well because they were lucky, there's no reason to expect them to continue doing well in the future. Now, the survivorship numbers in Canada over 10-year periods are about 50%. So 50% roughly of mutual funds, of actively managed mutual funds, close every 10 years. The result of that is that when you go to the bank or wherever, and someone is telling you about why you should invest in actively managed funds, And this is a big problem in Canada. Like most investor dollars buy assets or in actively managed mutual funds in Canada. In the US, it's about 50% in active funds, the rest in passive. But Canada's trailing behind the US in this regard for whatever reason. Now, the survivorship piece, if you're looking at a group of funds from whatever fund company it is or whatever bank, all of the funds will have done well over whatever time periods you're being shown. But the reason is not because active management works and what I'm saying isn't true. The reason is because you're only going to see the funds that have survived. But that tells you nothing about how those funds are going to do in the future. It's just it's a pure outcome bias. But the long-term data on active management are quite damning. So to invest in index funds, to do what I'm saying is sensible, to capture a low-cost, well-diversified portfolio that captures a cross-section of all of the stocks that exist in the market without paying the high fees that actively managed funds have. I didn't mention that. Not only are actively managed funds trying to guess and predict randomness, which is obviously not going to be successful long-term, they're charging a premium to do so. They have much higher fees than index funds. So a couple of ways that you can access low-cost index funds. Wealthsimple does a pretty good job building low-cost index fund portfolios. They make everything very easy. It's a good user experience. It's very hands-off. Depending on the amount that you're investing, they may give you access to a financial planner, and they're going to charge you a fee for all of those services, which makes sense. And I have no affiliation with Wealthsimple, just so everyone knows. I think they charge 0.5% up to $100,000, and if you have over $100,000, their fee drops to 0.4%. But a pretty good option, better than going into a bank branch and being sold an actively managed mutual fund. Questrade and the other discount brokerages that exist in Canada are another great option. In that case, it's a little bit more hands-on, requires a little bit more research and understanding of what it is that you're doing. But you can purchase low-cost index funds yourself in a self-directed brokerage account. In that case, you're going to save the 0.4, 0.5% that you'd be paying to Wealthsimple, which over the long term can be meaningful, but you're also not getting the hands-off experience. But in Canada, in the last 2 years, we've had this influx of products from companies like Vanguard, BlackRock. These are ETF companies. ETFs are exchange traded funds. They're generally low-cost investment products. Bank of Montreal. So all these different companies have come to market with these products that are what I call single decision funds. So 5 years ago, if you wanted to do what I'm saying and build a low-cost index fund portfolio, you would have to buy 4 or 5 different funds to build your sort of perfect globally diversified portfolio. Today, you can accomplish that with one single product. You just choose the mix between stocks and bonds that you want, and then the ETF company implements and manages the index fund portfolio. So that makes the idea of do-it-yourself investing through a self-directed brokerage like Questrade increasingly appealing. But in general, those are two good options: robo advisors like Wealthsimple and self-directed accounts like Questrade. I think that's about all I have to say on investing. And I think next we're going to open it up to questions.
You got it. Thank you so much, Ben. That was fantastic. I see the chat exploding with all sorts of questions. So I want to get right to it and ask you a few questions as well. So I think we have a question here from Lena in the chat, and I'm going to try and combine a few questions here. So the question was, are there any tips, tricks, or methods in how to choose a stock? And maybe I can bundle a second one in terms of how do you know which, for example, mutual funds are good? What should we avoid and what should we look out for?
So 2 really, really, really good questions. I'm going to answer them separately. So choosing a stock, the easiest rule of thumb is to never buy an individual stock. There's no secret formula for picking stocks. Individual stocks are, I mentioned that concept of risk premiums earlier, where you're buying future profits at a discount. That works really well in a diversified portfolio. You can reasonably expect to earn the expected return if you're properly diversified. When we start talking about one individual company, there is an enormous amount of company-specific risk that makes the chances of actually collecting the expected risk premium basically negligible. You're basically going to get a random outcome with an individual stock. And there's a couple of other really important data points that I want to share on individual stocks. In the US from 1926 through 2015, 4% of the stocks that existed in the US stock market over that time period, 4% of them were responsible for all of the wealth creation generated by the US market over that time period. So that's like a few hundred stocks of the 26,000 that existed over that time period. And in global stock markets from 1990 to 2018, it was even lower. It was 1.3% of the stocks explained all the net wealth creation. In statistical terms, the way that we can describe that is that there's a huge skewness in stock returns, meaning that most stocks actually don't do very well over the long term. A relatively small number of the stocks that exist drive most of the wealth creation and the returns in the market. So to think that we can identify one of the stocks that's going to be responsible for all of that wealth creation ahead of time, knowing that it's literally like finding a needle in a haystack, to think that we can do that is, I don't know, overconfidence, I think, which is something that affects a lot of investors. So yeah, my favorite rule of thumb for how to pick an individual stock is don't. For the second question, when you're looking at mutual funds, I mentioned costs, I mentioned diversification, I mentioned avoiding active management. Those are all really important. So you want to be looking for index funds is number one. That's not a universally good answer though, because there are lots of index funds that are technically tracking an index. Like there's one when the whole cannabis legalization was happening, there's an ETF that became popular called HMMJ was the ticker, but it was a cannabis ETF. And it had a relatively high fee, 0.7% of the invested assets per year were charged in fees. And to compare, like one of the asset allocation ETFs, those one decision funds that I mentioned earlier, you're going to pay between 0.2 and 0.25% to own one of those. So this marijuana ETF is much more expensive, and it owned a relatively small handful of companies in a single industry. And investing in that, by the way, ended up giving you a really bad outcome, although it looked like it was going to be a good outcome for a short period of time. And that tends to happen when new industries and technologies pop up. Yeah, so saying, oh, we should invest in index funds, that's not universally good, because some index funds are effectively like active management. They end up being sector bets, which is probably not a good thing. So look for low fees, look for index funds. That's the best tip.
I love it. I mean, you touched on a lot in a few minutes, so thank you. I know we have a few minutes left, but I do want to squeeze in one more question we got from David G. All right. So the question is, how do we balance reducing, managing, or eliminating a large amount of debt and saving and investing? Should we wait, prioritize one versus the other, do them all at the same time? What do you think?
So you, Leora and Haruka, you guys can chime in on this too, but I'll say what I think. Debt is part of the overall asset allocation decision-making process. Now, we didn't get into asset allocation very much or at all, other than identifying that there are risky assets and safer assets. So when you build a portfolio, your asset allocation, other than choosing your approach to investing, so if we're saying index funds, great. Next step, you've got to choose your asset allocation. How much risk do you want to take? How much stock exposure versus bond exposure do you want to have in your portfolio? That's really important, and it's going to be the biggest driver of your expected outcome over the long term. So it's a decision that needs to be made carefully. The way that debt fits into asset allocation is that debt is kind of like a negative position in bonds. You're the bond, or you've sold the bond. in the case of having debt. So when you have debt, it's kind of like, well, a negative position in bonds is kind of like having additional exposure to risky assets. So for example, if you look at sort of past volatility and drops in bad years and stuff like that, and decide, well, I think I want to be in a 70% stock, 30% bond portfolio. The 30% that you're going to be allocating to bonds is going to be a really inefficient use of money, because you have debt that you owe on one side, and then you're buying debt or investing in debt on the other side, which doesn't make a whole lot of sense. And the way that I think that you can use that information is, if 70-30, 70 stocks, 30 bonds is what makes sense to you, maybe paying down the debt first is the sensible thing to do.
I love that response. Thank you. I know we only have 2 minutes left, so I do want to take a moment to just wrap up. Ben, thank you so much. I know there's plenty of questions in the chat, so feel free to have a peek as well. So, folks, thank you so much for tuning in to our first financial literacy session in the series. Just a quick reminder, as we've been saying, we have 3 more happening on the next few Sundays, so November 8th, 15th, and 29th at 6 p.m. We're going to deep dive into budgeting. So if you realize, might need to learn a little bit more, tune into that one. Investment 101. So a lot of the topics that Ben is just touching upon, we'll do a bit of a deeper dive into some of those areas. And finally, November 29th, Money Diaries. So hear from folks from all walks of life, from students to working professionals, in terms of what they're actually doing with their money. And hopefully we can learn a lesson or two from them. So once again, thank you so much, Ben. Thank you so much, everyone, for tuning in. We're so excited. And hopefully you can join us for the next few sessions.
And if Leora, if I can add, if you were compelled by Ben's conversation, check him out on YouTube at Ben Felix, or his podcast, Rational Reminder. It's just a whole lot more of this. So I'm a big fan. So I have to say, if you're interested and want to know more, check those out as well. It's a great resource. Thank you, Ben. Appreciate it.
Yes.
Thanks,
thank
guys.
you so much. Thanks so much, everybody.